Hello, welcome to Wanderer Financial. Today I'm going to talk about gaps left on the chart. A gap is simply an open space left on the chart between two candles where no trading occurs in the middle. They're often caused by things like analyst recommendations, earnings reports, or takeover rumors. There's a saying amongst traders that all gaps must be filled, and quite often we'll see stocks retrace, fill the gap, and then reverse again to continue on their way. So it's worth identifying them on a chart. The gap is measured between between wicks. Some people will take it between the bodies of the candles. I take them from the wicks. So basically, you can see in Disney here, the high of the day this day was 117.86. The next morning, the stock gapped open higher, traded up here, traded as low as 126.36. Leaving a gap of about $9 in between here. So basically, moving forward, the stock has continued up, bouncing around a bit. But what we'd be looking for now with a gap like this is you would tend to see, what you'll see is if the stock starts dropping back down, you'll see this 126.36 level. Often it'll turn into a bit of a support level. So we'd watch for that. Once it does break into the gap, which is what we would call this space here, once it breaks below 126.36, then we would expect a gap to fill. Maybe not that day or not that week even, but over a period of time, we would expect the stock to continue dropping until it filled this gap, meaning it traded down to 117.86, at which point we would expect also that maybe there would be some support at that level. So those are the kind of things we're looking for in a gap. So let's look at a few more. Let's have a look at now. So you can see this one. This had a big earnings gap. This was earnings. Opened up the next morning, popped up here, traded up for a couple weeks or a month, but then faded, dropped back down. Really looked like it was going to fill the gap here. But what'll often happen is other traders know about the gaps, and they look to place their orders around that level too. So people are starting to think, well, maybe now is a bargain. I'm going to place my buy order a little bit above the gap, expecting that there's going to be a lot of buys at the gap fill, and there it went, bounced right off of there. Forward, another earnings gap, big jump the next morning. Same kind of thing as now, faded back down, except this one did fill, dropped back through the gap, and now reversed again. But anyways, once this, about at this level, we would have been expecting that maybe this was going to start dropping, continue dropping and to fill this gap. Lows. This is an interesting one. Let me pop up moving average so you can see this. This one's got a gap here. Let me clean this up a little bit. This one left a big gap here. And the interesting thing about this one is that the gaps here, this is a 200-day moving average, which is often a major support or resistance area as well. So what I would expect to see here, and it kind of happened today, is the stock popped up near the 200 and then started to fall back. What we would see is that the bottom of the gap would be acting as resistance, especially when it's got something added to it here, like the 200-day moving average. So I would expect some pretty decent resistance at this level. Love, this was another, well, this wasn't an earnings, this was just a gap. I'm not sure what caused this one anymore, but you'll see that one gap down, then you see this retracement. You see this a lot, this is a gap fill. It just gaps, follows through for a few days, then boom, pops back up, fills the gap, and then once the gap is filled, drops back down again. That's what we're talking about. So basically, you're just watching these gaps. You want to mark. I often mark both sides on the chart like this, and then you just kind of watch them. They often act just like a support and resistance line. And that's really about it for gaps. Thanks for watching.
watching. Don't forget to subscribe.